and welcome to today's webinar. I would like to introduce today's guest speaker. His name is Doron Peleg, and he is the CEO and founder of RiseWise Property Review. Doron has over 20 years experience in risk management as co-founder and managing partner of PELEG, KESSEL CO in Tel Aviv, and as the executive manager at Westpac Banking Corporation in Sydney. Doron is an expert in a wide range of risk management methods, and he is a co-developer of the property risk rating algorithm. I would now like to hand you over to Doron, who will begin his presentation.
Good afternoon, everyone. My name is Doron Peleg from RiseWise Property Review. So basically, our company specializes in risk management in the residential property space. We provide services, obviously, to property investors and buyers, but also to property professionals like buyers agents, sellers agents, and property developers. We also provide services to banking and other lenders. Now, basically, the approach that we have is to take the risk concept that we know from financial markets, from stocks, and for other risk classes, and basically we have built models and information gathering processes around property. So basically that's what the company does. Now the purpose of the webinar today is actually to talk about the property risk, how to mitigate it, and first obviously I will explain exactly what do we mean by property risk, what is it exactly, what is cash flow risk, what is equity risk, what could go wrong and how to assess it. The second thing, I'll talk about areas with low risk, with high return potentially. I'll also talk about red flags, high risk areas, high risk properties, etc. And finally, I'll explain why so many people are overconfident in the skills and why so many people have currently only one investment property. They cannot build equity and they have a very bad experience from their investments. Okay. Now, let's start actually with property risk. What is property risk? The key factors that we have in property risk are basically the capital growth risk, or the equity risk as we call it. The second thing is cash flow risk, which means we plan to get some cash flow, but actually the cash flow is very poor. And the third one is settlement risk. Okay, now let's review these one by one. What is equity risk? A certain person has specific projections or aspirations regarding his property. He invests money, he buys either an existing property or off the plan, and he would like to get certain capital growth. Now, if obviously the value of the property is going down, so this is obviously not a good outcome. But another bad outcome is when the property value goes up only 1 or 2% a year, which means very poor capital growth. This is a risk that actually happens in many cases. We see that a lot in Australia, very poor capital growth in many areas. Okay? On the other end, we have low risk areas, which means areas that the risk that there will be little capital growth is very low. Okay, a key example is obviously the inner west suburbs of Melbourne, houses in the inner and middle rainbow of Sydney, etc. So that was the first one, which is the equity risk or the capital growth risk. The second one is cash flow risk. We all the time we go to the banks or financial planners or advisors or whoever wants to sell us something, and then we say, okay, we're going to buy a certain property for, let's say, 600, and the rental return will be 500 a week. And eventually, at the end of the month, we need to pay out of the pocket $35 and all good. But what we don't know that in many cases, this is not really straightforward. We have some projections, but it's not really happening because we buy the property and we see a large number of properties in the pipeline, or we see a problem with the season, like beach suburbs area in Sydney. The property itself is not good enough, it's on the main road or other, but the bottom line is that we have very poor rental return because the property is vacant for a long period of time, or people don't want to pay what we want. They don't want to pay 500. They're willing to send us offers of 420 or 430, and it is what it is. Okay. So this is the cash flow risk. And the third one, which is unique to off-the-plan properties, is settlement risk. So basically, when I buy an off-the-plan property, I buy a promise. I buy an idea. And basically, I'm saying to commit to pay, let's say, $500,000 in 12 months, 18 months, when the property is completed. The risk that I'm taking is that the bank is not giving me a loan at this point of time. The bank is giving me an approval in principle. The problem is that only once the property is completed, just before the settlement, the bank sends a valuator to value the property. Now, if I have made a contract for $500,000 and the valuator says that the actual property value is only $450,000, we have a problem because I've made a commitment and currently the bank is not willing to lend me what I wanted, and I need to cover the shortfall from my pocket. Now, this event of settlement risk and the problem that property prices go down between the contract date to the valuation date to the completion date happens in more than 50% of the cases, okay? Which means in more than 50% of the cases, you're buying an off-the-plan property today for a certain value, and the value of this property will be lower in the future. It could be 5% or 10%. Now, who is saying that it is lower? The valuator. And on that basis, you will be struggling to get the loan that you need. Now, one of the common mistakes that we see is that people say, yeah, don't worry about it. Everything is low risk because in 20 years, property values will go up. Now, in principle, it's correct. In a time span of 20 years, property values will go up. But you have to be very concerned about the risk because, number one, you want to have good capital growth, and this will have a huge impact on your equity in 20 years. And the second one, you want to have good, you do not want to pay $1,500 a month on a regular basis, like what people are currently doing in Gladstone or Mackay, to cover a shortfall with the rental return, right? So what you want to do is to take control over the situation. And you take control over the situation if you make a good decision, you take a step back, you assess the risks and the returns of the property. And if you have any questions, you can type them and then Jeremy can share the questions with me. Okay. Now, the next topic is basically how to find suburbs or areas that have low risk and good capital growth. Okay, because obviously that's the ultimate objective, right? To take low risk, to have a good rental return, and people who did that in Sydney in the last 5 years have done really, really good. Now, basically based on our algorithm, we have dozens of factors. So actually we need to start with what not to do. We need to eliminate out all the bad things that we have. Okay? So the number one factor that we have to eliminate is areas with poor economy. Okay, based on our researches and algorithm, good economy in the area, and I'm not talking about a suburb, I'm talking about a city like Perth, Sydney or Brisbane, etc. So good economy is in 83% of the cases is the strongest prediction for good capital growth. Okay, for example, in Sydney, regardless to what you bought, and we'll talk about it later, 83% of the properties outperformed the overall market. Now, what do we need to eliminate out? At this specific point of time, the number one example is obviously Perth. The economy in Perth is not really good. All the statements, whether it has reached the bottom or not, is not really helpful. What we see poor economy, we see high unemployment, we don't see any changes in the near future, what do we need to do? Filter out this area. Other areas that we need to filter out, for example, are mining areas. Okay, we don't really care if they have reached the bottom or not. That's a different conversation. The point is that they're not going up because there is no sustainable economic growth. Okay. Now, what do we mean by the word sustainable? Sustainable is something that is sustained for years, not 1 year, not a couple of years, and not boom and bust. Sustainable are usually large cities or areas like the Central Coast in Sydney or Geelong in Melbourne around large cities. Okay, so basically these are the key principles. So this is the first thing that we need to grow. The second thing that we must eliminate is areas with a very large supply of units. Now, obviously, a lot of people are currently trying to sell off-the-plan properties in the inner city of Brisbane and Melbourne and even the southern, the western suburbs of Sydney and other areas, even in Perth. Now, there is currently a significant problem of oversupply. So, if we see a problem with oversupply, if it's on a red zone list, and you can go to our website and get it for free, the 100 red zones or no-go zones reports. So basically, we just need to stay away from this one. We don't really care about the quality of the project and the promises of the developer. It's irrelevant. We have to eliminate these areas or these properties out, and only then we can move on to the things that we want to see. So what we want to see, obviously, we want to see sustainable economic growth like Sydney and Melbourne and some areas in southeast Queensland, okay, that has some good prospects. We're looking for established suburbs, classic suburbs, particularly in the middle ring. We have seen in a very large number of cases, and it is proven statistically, that areas in the middle rings, established areas particularly, carry low risk and deliver good return. Property values in those areas across the entire country, by the way, do not go down, and even if there are extreme cases that they do go down, it's only a very, very short, for a short time frame, and the decline is relatively short. Okay, so this is low risk, and obviously there is good demand, and we see overall in a long-term and investment strategy, really good capital growth. Okay. Now, another thing that we need to see is suburbs with a very large number of owner-occupiers. Okay, because of two reasons. Number one, if you have owners, so usually they stay in the suburb for a period of, it could be between 11 to 13 or 14 years on average. And the second thing is that if you have a good area with owner-occupiers, usually houses in these areas, in these suburbs, attract more people, more owner-occupiers. There is a stronger demand. It is important for them to live there. It's not just an economic decision. We have other factors like schools and friends and other stuff. And therefore, the prices, obviously, in established areas outperform the market in many, many cases. Now, the other thing that we have to consider is obviously the property type and configuration. Because you can buy in the best suburb in Australia, in Manly, okay, or one of the best suburbs in Australia, mainly in New South Wales. But you need to buy the right property. If you buy a small one-bedroom unit on the main road, poor market condition, property condition with no parking, so you will not find tenants. And in the long term, when you want to sell it, you will find very few people who want to buy your property. You will be struggling to sell it. And obviously there are different configurations and different properties, but the point is that you need to know for each suburb what is the right property configuration. And obviously the seller's agent is not going to tell demand. Now let's talk about the red flags that we need to be aware of. Okay. So the number one is areas that have proven to be very, very poor. Okay, for example, the mining towns. And again, but very poor economic growth, unsustainable economic growth. The number two, as we said, a very large supply of property. So let's talk about the classics. We have the Valley in Melbourne. In Brisbane. We have South Bank in Melbourne. We have Melbourne with 3,000. We have a very large number of areas in the western suburbs of Sydney. We have areas in Perth. All of these areas have a huge oversupply of properties. Okay, so this is for us a red flag. And the next thing is that we need to find areas that have premium for owner occupiers, which means if we see areas where it could be crime, it could be a lot of very young population, a lot of issues in the suburbs, this area does not appeal to owner occupiers. This area usually carries a higher level of risk. The premium assets is something that we also have to be careful of. Now, what is a premium asset? A premium asset is an asset that is significantly more expensive or significantly larger or significantly different from other properties in the suburb. Now, the median price could be $500,000, but if I buy a property for $900,000 in that area, this is considered in that piece of the world a premium property. Or the same thing, if I buy in Sydney a two-bedroom unit when in the good areas it's around the 1 million mark. If I buy a sensational property for 2 million, 2 bedrooms, this is a premium property. I would be struggling potentially to sell it because there are very few people in Sydney who want to buy 2 bedrooms property for 2 million. And also I might be struggling to rent it out because people don't want to pay $1,500 a week for 2 bedrooms property. So we have to be very careful about the premium assets, and we have to know at any point of time that it is premium regarding or in relation to the existing properties in the suburb. The premium could be even in Ipswich. If I pay 800,000 when the median is 400 or 450, I might have a significant issue. Okay, and obviously the wrong property configuration, and one of the classic examples is units with an area of less than 50 meters. Not only you will be struggling to find potentially tenants or to sell it out, also you're going to have some lending restrictions when you want to get finance or when you want to get refinance for a property, for another property. So the property configuration is also a key thing. Now the next topic or a key common question is, where are the key growth areas with low risk and good long-term capital growth in Australia? So the number one area in Australia is the inner west suburbs of Melbourne currently. Anywhere from Footscray through the west till you go to Sunshine and Sunshine West and then Keller Downs, etc. So basically, obviously, when you go out, the prices go down. But this entire corridor of the western suburbs of Melbourne has done extremely well, particularly in the last 3 years. And we saw that from 2016, from last year, this was actually a really good performing area, a high performing area, even better than the eastern suburbs of Melbourne or the inner east of Melbourne, which is the prestigious area that also enjoyed a good growth, which means currently this is number one, the western suburbs of Melbourne. The second one is obviously houses, if you can afford it, in the greater Sydney area. And the third area that might surprise people is actually established areas in Brisbane. There are quite a few. There is actually a large number of established areas in Queensland. When you buy a large house, a good piece of land in a good area, up to 10 to 15 Ks from the CBD with good prices. And also what we see in southeast Queensland is that many opportunities also in the Gold Coast. I'm talking about houses, not units. And in the Sunshine Coast area, in the Gold Coast, there are some lovely areas, anywhere from Main Beach and along the coastline through Burley Heads, if people know the area. And in the Sunshine, obviously, the #1 area currently from Diman and Capital Road is the entire Nusa area that includes Nusa Heads, and then you go down to Sunshine Beach, and all the way till you get to Colomb Beach. So we see good changes in demographics, and a lot of people are moving also from Sydney, from Melbourne, from Brisbane, a lot of cashed up business people, a lot of retirees, actually also a lot of families in that area. And again, we're talking about houses. We're not talking about units in these areas. So these are currently areas that carry a low level of risk. The risk that the property prices will go down or the Liverpool result is low. And in the medium to long term, these areas are projected to deliver good capital growth. Now, one of the other questions that we get, or different questions, are what are the media overact danger zones? Which means in some cases, you read the articles about from the media and you think that that's it, the sky is falling. And to us, a couple of things to mention here. Number one, areas like Chatswood and the North Shore in Sydney. This is overhyped by the media to say that there is a huge oversupply in Chatswood and the surrounding areas, and that Chatswood is a huge risk. This is a huge overstatement. There is a relatively large number of developments, but there is a huge demand for properties in Chatswood among local and overseas investors. And very good area, nice location, sensational school, very close to the CBD by train. And so this is overhyped, and the risk is not that high. It's maybe medium, definitely not high. Chatswood is a good area, and the entire North Shore. And the second area is Queensland. So Queensland is a big state. The fact that we did have the problem with the mining towns, and the fact that we do have currently a huge oversupply of units in some areas of Queensland, these facts are correct, absolutely. But we cannot just discount the entire Queensland, which is from the Gold Coast till Cairns, because of that. We have to be selective and to say, okay, if we focus on houses, if we focus on good areas in southeast Queensland, then you see the results. You see the data, number one, you see the projections, you see all the information that flows to us, and we have quite a few good areas that we cannot just discount them because they are in the very large state of Queensland. Now, and again, if people have any questions, so just feel free to type them in. So the next question is, okay, so we said that there are risks and we have problems with oversupply potentially. How to mitigate the risk, or how to minimize the risk and to increase the chances that we will deliver in the short and medium and long term good capital growth and good cash flow, because that's the objective of our investment. So I think that first, the number one risk that we have is actually the end of the negative gearing. Okay, people don't talk about it too much, but currently the chances that the Labour will win the election is something like 50%, even more. They've made a very clear commitment that they will end the current approach of the negative gearing, which means grandfathering of the negative gearing. If you have an existing property, which is an investment property, all good. You will be able to continue claiming negative gearing or losses from a rental from an investment property. However, going forward, you will not be able to do that. What does it mean? It means that if they change the structure of negative gearing, new investors will not want to buy existing properties, or the number of new investors who want to buy existing properties will be very low. So this is a risk. Now, how do we mitigate this risk? And obviously, we're not really sure if the level will go up or not, yeah, but this is a very possible scenario. How do we mitigate it? In a very simple way. We buy properties that are appealing for owner-occupiers, mainly houses or large units in areas like Sydney. Bottom line, properties that are well suited for families in good areas when you have low supply. In that case, even if there is the end of the negative gearing, you still have a really good property. You are not under the mercy of investors who have to buy the property. Okay? Now, if theoretically, instead of doing that, we continue buying small units, when we want to sell them, we can sell them only to investors. But if there's no more negative gearing, why will an investor buy from you an existing property if you can buy an off-the-plan property, get the negative gearing, and get a really good deal? Okay, so the number one risk, yeah, is potentially the end of the negative gearing, and we can minimize that by buying a property that is well suited for families, particularly houses. The second thing, how to mitigate it, is again what we said, what not to do. If you have a doubt, just don't buy. I know that many people are currently very active on the market and they're looking for opportunities and the great project or the great quality or the great developer. It doesn't matter. It could be the best developer in the entire universe. If there is an oversupply of properties, if there is a doubt regarding the area, just stay clear. And also you have to find either perform your own research or get an independent research company, because if someone sells you off the plan and he performs the research, yeah, what would you expect him to say? Okay, if a developer sells, the brochure is going to say all the great things about Queensland. What do you want him to say? There is currently a huge oversupply, we're taking a huge risk, stay away, this is a danger zone. So this is not a serious conversation, obviously. So what you need to do, review the information that you get, check if the person is independent, stay away from danger zones and poor performing areas. Okay? This will minimize the risk. And the third thing is take a structured approach, which means you're the investor, you're running the show. You're saying, okay, what is my budget? What is my strategy? Do I want to retire in 20 years? Do I want to move there in 5 years? What do I want to do with the property? And you have to have realistic expectations. Sometimes we see people who are, they are 32 and they want to retire when they are 35. That's not really realistic, okay? So we have to have a realistic strategy, realistic expectations. Then you need to narrow down your research to a regional area, then specific suburbs, and you need to make a decision which properties you are going to buy. Okay, and only after you're happy with the area, and then with the suburbs and with the properties, you make the offer, or if you don't know the area, you can use a buyer's agent or other property professional that you are paying to help you with that. Now, why am I saying you are paying to? Because if you don't pay to a property professional, it means that this person does not work for you. Okay? If a person arranges a free seminar in a very nice hotel during the weekend, he does that because someone pays for that. That's his business model. And usually that someone is the developer or big marketing company. That's how they work, right? So we don't work for free, right? We are a research company. We provide reports to our clients. Our clients pay for their reports. They get independent reports, obviously. If the area is good, it will be good. If it's bad, it's bad. But the point is that if you're not paying, you're not the client. So do your own research by yourself, by all means. But you have to be careful, okay? And the other thing regarding taking control over the process, you go to a free seminar. Obviously, they have a very nice idea to build a portfolio and they will be a multi-millionaire or whatever in 5 years. And then they just happen to have the best of the plan areas in Australia. Okay, that's fine. So we understand that they get commission from a developer to sell you off the plan. You need to take a step back and to ask, does it support my strategy? Did I want to buy a small unit in a high-rise in South Bank, Melbourne, or Valley, or whatever it is? Yes or no? If the answer is yes, that's what you're looking for, continue with the research. Is it high danger zone or not? Then you have to take a structured approach. You're not going to be in a position, you don't want to be in a position that you are sold the property, which means someone is actively selling to you the property, and a couple of years later you are finding yourself with a really poor performing property and you're saying, I don't believe that I've made that decision. Okay, now we saw dozens of investors who invested in the mining towns, okay? Why? Because they were sold properties. In 2012, people in Sydney didn't even know where's Gladstone or Mackay. Okay, what is 647 kilometers north of Brisbane. But there were huge marketing campaigns with many millions of dollars that were paid to many. Okay, and then suddenly you hear IT professionals in Sydney talk to you about Mackay or Gladstone or whatever it is in the mining towns. This is the next thing. So they were sold properties, and we all know what's happening with Gladstone, Mackay, and the other mining towns, right? Huge losses. Okay. So basically, these are the key points that we send to think about the negative gearing and to always try to buy property that appeals to family. Number one. Number two, to know what not to do. Number three, to take a structured approach. And number two, to know that if you are not paying to a property professional, someone else is paying him, most likely, and someone else, okay, pays him some, and he gets potentially very generous commission. Okay? Now, I want to give you some numbers so people will understand what I'm talking about. If a marketing company sells a property in a poor performing area like the Valley or South Bank, etc., the standard commission currently on the market is between 5% to 6% of the value of the property. Okay, which means if the value of the property is $500,000, the commission is $25,000 to $30,000. So the free seminar with a great free dinner one evening costs you $25,000. So if you're willing to pay $35,000 for free seminar, go for it. So just that. So that was the last thing. Now again, if people have some questions, feel free. Now the last thing is, many people are very, very confident, sometimes overconfident in their skills, and they make poor investment decisions. Right? Now, statistically, it's proven, and many graphs and many researches about it. But bottom line, the vast majority of property investors who wanted to have multiple properties have only one. The vast majority of the investment properties do not perform well. Obviously, when we go to the Your Investment Property magazine, obviously they're going to show us the success stories and how a person who started when he was 21 with $5 in his pocket currently has a portfolio of $5 million and then the properties, right? What they're not showing us is all the people who lost money. What they're not showing us is people who bought a property 5 years ago for $600,000 and the current market value is $610,000. Okay, what they're not showing us is that in many cases, if these people with all the success stories, if they want to cash out their properties right now with a fair market value and the marketing cost and then the agency cost and all the other stuff and the tax, etc., the net equity will be very, very low, maybe $500,000. No, not that $500,000 is a small number, but the point is that sometimes people are overhyped all the success stories, and you're saying everyone can do it, right? So I can also do it because it's just kind of a plumber or a carpenter, and I'm whoever I am, right? So that's not the case. So number one, people have to be much far more careful Okay? And the second thing, you have to be aware of the risk. People have a tendency to think that things will go good. And it's regardless whether it could be the property market, it could be stocks, and it's even, by the way, gambling and casino. That's how it works. Every person thinks that, yeah, it will not happen to me, right? But statistically, it does happen. And the key example, again, that we have is Gladstone and Mikhail. Okay, we talked to many people for years. I haven't seen even one person who told me, yeah, Gladstone and Mikhail is a risky area. I know that I have good chances that I will lose half of my equity, or I will become bankrupt, and I have to sell my own house. I'll have to move to live in rent because of a poor investment. I haven't seen any person who talked about that. People talked about the worst case scenario of 10% price decrease, or 20% price decrease. And the point is that people underestimate the risk. They underestimate the impact, and then things happen, and not in the good way. Okay, so you have to be aware of the risk. And obviously, the third thing is you're overconfident because the sellers agents and the marketing company, they show you the good things. And they have something that we call key messages. Okay, for example, they're going to say, yeah, South Bank, Melbourne, everyone wants to live in a walking distance from Melbourne CBD on the water. And that's it. They repeat these key messages. This key message. Everyone wants to live on the water in a walking distance from Melbourne. And the other key message is this is the best development ever. This is the best project ever. This is the best area ever. Okay, and people are buying in. And then they're saying, okay, so they have two key messages. That South Bank, Melbourne is a place that everyone wants to live in, and that the quality of the development is outstanding. And that's it. And they're overconfident because that's what they truly believe in. Now, and the last thing is that there is a big difference between men and women, actually. And women are usually by far more cautious. They take a bit more, by far more structured approach. The men, and you can actually read on our website and the news and research about men and women, and why women are statistically better investors than men. So basically, that's it. Now, if people have any questions, so Jeremy, if you want to run the questions.
Are we good for questions now, Doron?
Yeah, I'm ready.
All right. So we do have a couple of questions that have been submitted. The first one is, what do you think about the Gold Coast? Is the economy strong there?
Okay, that's a good question. So currently the economy is strong, but the Gold Coast is a bigger problem. Number one, you need to know that a very large number of people, particularly high-paid people, do not physically work in the Gold Coast. They actually work in Brisbane. The second thing is that currently there is a boom in the Gold Coast because of the Commonwealth Games in 2018. Okay. Now the good news is that overall the houses in the Gold Coast have good demand, have good projection for good capital growth. The bad news is that units are far riskier. Okay, because of few reasons. Number one, there is a lot of uncertainty regarding what will happen after the Commonwealth Games, and you just need to talk to the locals and to see that there is a lot of uncertainty in there. Number two, there is a large supply of units, and the Gold Coast Council or all the AGA, all the municipalities are very generous with the building approvals. Okay, and the third thing is that it's kind of a hybrid between holiday apartments and small units are not really suited for families. So bottom line, houses, yes, in some areas. Units, they carry a larger level of risk, and you can get usually for the very same price houses in relatively nice areas in the Gold Coast.
Okay. The next question, you kind of touched on it a little bit with what you just said answering the first, but I think it's still worth answering. Would you recommend buying units in Brisbane? Are there many attractive offerings currently for sale?
Okay, so actually units in Brisbane are currently not an attractive offering. Let's start actually with houses. Number one, houses provide by far better attractive offering, and just this week we sent a media release on the research that we've done regarding Brisbane. When we take a long-term view of 40 years, we see that houses in Brisbane present a really good value comparing to Sydney and to Melbourne and to other places in Australia, and also comparing to units. The second thing regarding units in Brisbane, we said earlier that we need to buy properties that are well suited for families. In Brisbane, local families have very strong preference for houses on large blocks of land, right? So obviously, this is not an ideal one. And the third thing obviously is that there is a large supply of units currently, okay, in the valley and other places, which means if I buy a unit today, later on when I want to sell it, I have to compete with a very large number of investors, okay? And based on all of these reasons, together, units at this point of time do not seem to be an attractive investment strategy in that area. And in the entire Southeast Queensland, you can get offering anything from $450,000 upwards for houses. So why would you buy a unit? So that's based on our research. In addition, I will talk about more about Brisbane and the entire Southeast Queensland in the Sydney Buyers Expo. There will be a session for 1 hour just for that, because this is a big area and a lot of things are currently happening in the property market.
Okay, thank you. One final question, just focusing on the Queensland market before we move on to a different one. But a question's been asked, and it's an event that I'm sure is on all of our horizons, but how do you see the Commonwealth Games affecting the pricing of houses and units on the Gold Coast?
Oh, that's a classic one. So we have to break it down again to houses and units, and first we need to understand what is the Commonwealth Games. So if people don't know, this is a really big event. It's not like a mini Olympics. It will take place next year in the Gold Coast. Now, what is currently happening in the Gold Coast physically is that there is a lot of work, a lot of developments, a lot of changes, a lot of money is being spent, and many companies work 24/7. Which means we have a lot of workers currently in the area. Okay, so this is the context. And additional context that people need to know is that in the Gold Coast is not just surface paradise, okay? The Gold Coast has many well-established areas with great schools, okay? Like Broad Beach and Valleyheads and Main Beach and other areas that are really great with great schools. Okay, that's important to understand, and this leads us to the distinction or the differentiation between houses and units. Okay, now let's start with houses. Houses are extremely unlikely to be impacted by the end of the Commonwealth Games. Okay, maybe some investment properties would be really good school. You'll find the owner-occupier ratio in these areas are something between 80 to 90%. No one is going anywhere. And as we said earlier, a very large number of people who live there in houses and make good money, they actually are the business people or work in Brisbane, which means houses are unlikely to decline, and even if they do, it will be really tiny. It is unlikely. Units, on the other hand, is a different conversation, because we see short-term workers that will probably be gone after the Commonwealth. We see a lot of uncertainty from local buyers and also investors. That's the conversation, and again, I'll talk about it more in the expo because there are a lot of changes and investments that are being made by the Queensland government to lift up the entire southeast Queensland area. So a lot of that depends on the Queensland government. But if you want to mitigate your risk, Gold Coast, absolutely fine. If you buy a house in the right area, in the right house, the right property configuration, condition, etc., you have low risk, just buy and hold for the long term. Next question.
Next question. All right, so moving to a more national approach, what is the risk that Labor will win the election and end negative gearing?
Oh, that's a good question. Okay, so let's see. So number one, let's understand the risk and let's try to understand what's happening currently and what are the chances and what is the scenario, okay? So there are currently 3 different numbers or indicators that we need to look at to see what are the chances of the Labour to win. Number 1 is housing affordability, which is currently not really good and it's not going anywhere. Number 2 is wage growth or salary growth. Currently it's not happening, and this is an indicator that is published by everyone. Again, the Australian citizens are very, very unhappy with the poor wage growth. And the third indicator that we need to look at is the polls, and currently the Labour are significantly ahead, okay? So all of these 3 basic measures lead to, at this point of time, to the conclusion that it is very possible that the Labour will take the election, and they've made a very clear promise to completely change the negative gearing, which means if you have a property as an investor, you can still claim losses, but if you are a new investor, you can buy only a new property. Okay, so that's the context. Now let's see what the impact is. Now, besides of Sydney, I'll talk about Sydney in a second, the impact will be mainly on units. In many areas in Australia, the majority of the people who live in units are renters, which means the majority of the units in many areas in Australia are investment properties. Okay, which means these investment properties might be struggling to find buyers. If I have 1-bedroom property and this is a property for investors, this is an investment property typically, and even in Bondi or Manly or anywhere that you want, I will be struggling to find buyers. So that's the first problem with units. The second one, the stronger demand and stronger supply of off-the-plan properties. We're going to see a large, we believe that there will be a large number of building approvals again of units, which means bottom line, a larger supply of units and lower demand by investors to existing units, which means this put properties that are pure investment properties or are not suited for families in a greater risk. So that's in Australia. Obviously, houses is a different story because there's not too much land. You cannot just manufacture land in the inner west of Melbourne or any other good area, established area in Brisbane or Gold Coast, etc. And the second thing, as we said earlier, houses have a very large percentage of owner occupied. Usually it's more than 80%, which means houses are less likely to be impacted. Now let's talk about Sydney. There's not one Sydney, there are actually 2 cities in Sydney. The first one is the inner and middle rings, the eastern suburbs, city, northern beaches, North Shore, etc. The second one is the western suburbs, Parramatta and out. Okay, so in the inner city and the AAA suburbs, okay, the impact will be limited. Why is that? Because number 1, you don't have supply of properties. Number 2, many people want to live there. And number 3, even when you have off-the-plan properties or new properties, these are considered usually premium properties. They are significantly more expensive than the current properties on the market. For example, in Manly, you cannot just build a new unit block in a standard price of 1 or 1.1 for 2 bedders. New properties, really great buildings with all the facilities and lock-up garages, underground parking, etc., could cost between 1.5 to 1.8, even 2 million for 2 bedders. Which means off-the-plan properties are limited, number one, and number two, they are far more expensive, and therefore, if you buy a good existing property in a good area and properties that are suited for families, even if they are units, like 3 bedrooms unit or very large 2 bedrooms units, your risk is relatively low. Now, houses, obviously in city, the risk is low. There's no houses, no land, even up in Balkan Hills. Very small number of approvals. Units, a completely different story in the western suburbs. Number one, we see a very large number of projects in the pipeline. And number two, the New South Wales government has made a commitment to release more land and to build more, which means bottom line, units in the western suburbs carry a high level of risk in that scenario. Okay, next question.
All right, next question and final question as well. What is the difference between RiseWise and other reports like CoreLogic?
Okay, that's a good question. Okay, so number one, CoreLogic, they deal with data. They are the number one data provider, and that's what they do. We are risk managers, and we came from financial services, executive managers, senior managers, heads of, etc., senior positions in the risk space. Okay, which means we assess the risk of things that will go wrong. CoreLogic, we're not going to tell you, these are the 100 danger zones. CoreLogic are not going to tell you this is a red area. Okay, that's the first difference. The second difference is that we have fundamental analysis. CoreLogic use data, and we also use information. Okay, for example, when you asked me a question about the Gold Coast, so based on our information gathering, if you get a report from us about, let's say, Broad Beach, so we can talk to you lengthily about Broad Beach Public School, the catchment area, the performance of the school, the income of the families, and we are confident to tell you that after the Commonwealth Games, people will not go out. You know why? Because our fieldwork and our information gathering includes a lot of information that other companies just don't have. And the third one, obviously, we are currently the only company in Australia that deal with the risks for individual properties. No one is doing that. They can also only give you a snapshot. And the last one, we're the only company that can give you custom-made reports for any needs. Your developer or property buyer, etc., we can give you a risk-based approach report. And this is the only product currently in the market in Australia. So these are the key differences. And if you want to learn more, because that was just a snapshot and I tried to cover as much as I could in a short period of time. So you can feel free to go to our website, www.risewiseproperty.com.au. You can go to the contact and feel free to contact us. And I will be speaking in the expo lengthily about the Brisbane and the Southeast Queensland market. And obviously, if you have any questions, feel free to contact us. Thank you.
All right, Doron, thank you very much. Both I and everyone listening in today would like to thank you for offering your time to enlighten us on the risks related to property. As Doron mentioned, ladies and gentlemen, if you would like more information, please do visit the RiseWise website. It's risewiseproperty.com.au, where you can find more information as well as details to contact Doron. And thank you all for tuning in today. This is the end of the webinar, ladies and gentlemen. Thank you.
Excellent. Thank you so much, Jeremy, and thank you, everyone. Have a good afternoon.